artificial intelligence would be this ultimate deflationary force. Like, the narrative was so simple.
Oh, yeah, completely.
Yeah.
AI boosts productivity, code writes itself.
Right, and it drives down the cost of everything. But, I mean, looking at the absolute sea of red on the market screens today, it looks like this massive, desperate global race to build that AI. It might actually be the very thing driving inflation through the roof. Welcome to Market Recap. I'm Daniel.
And I'm Mira.
So today's Thursday, July 16th, 2026. And if you were watching your screens, you already know it was a distinctly brutal, totally risk-off day. The Nasdaq 100 plunged over 700 points.
Ouch.
Yeah. Gold completely crashed below the psychological $4,000 threshold, and the 10-year Treasury yield climbed back up to roughly 4.569%. So we are pulling from a massive stack of sources today for this deep dive.
We really are.
Overnight geopolitical reports, central bank transcripts, pre-market corporate earnings. Our mission here is to decode exactly what happened and, why it actually matters to you.
Because today wasn't just some random summer sell-off. I mean, we're going to unpack how a mix of geopolitical shockwaves in the Middle East, plus massive AI capital expenditure jitters bubbling up in Asia, and, well, hawkish Fed speakers right here in the U.S., all just converged.
It was a perfect storm, really.
Exactly. They formed this perfect storm for a broad market pullback.
And just to set the ground rules before we get into the weeds, and we are definitely getting deep into the weeds today, this show is strictly for market context and discussion. It is not personal investment advice or, an investment recommendation.
Right. We are just here to help you understand the baseline you're operating against.
Which brings us to our first question, session 1. What set the stage before the U.S. session? Because, the reality is the U.S. market didn't just wake up in a bad mood today.
No, not at all.
The inflationary heat that burned through Wall Street this afternoon actually started overseas, in the dark, while most of us were sleeping.
Yeah, you really have to look at the overnight narrative here. We essentially had this geopolitical powder keg detonate late Wednesday, which broke a very fragile diplomatic ceiling in the Middle East.
Right.
And the immediate inflationary heat from that event started forcing the hands of central banks, like almost instantly, particularly in tech-heavy Asian economies.
So the timeline here is critical for you to understand just how fast this moved. Let's rewind to late Wednesday afternoon. Just after 4 p.m. Eastern Time on July 15th, the U.S. military launched coordinated precision strikes against Iranian air defenses, like radar systems near Bandar Abbas and Qushm Island. Then, less than 3 hours later, Iran retaliated.
At 6:53 p.m. Eastern Time, right?
Exactly.
Yeah.
They launched drone and missile strikes targeting U.S. and allied bases in Kuwait and Jordan. And the immediate real-world fallout from that, the Strait of Hormuz is essentially closed to commercial traffic right now.
Which is just a catastrophic shock to the global energy supply chain.
Yeah.
We are talking about a major global artery here.
Yeah.
Around 20% of the world's liquefied natural gas and oil passes through that specific choke point.
Wow.
So when it squeezes shut, it instantly raises freight costs, spikes insurance premiums for tankers, and sends baseline energy prices surging. It's just a textbook supply shock.
Now, I want to challenge the instinct here for a second, Mira, because I see this all the time. When these military exchanges happen, the market reflex is often to treat them like an unpredictable natural disaster.
Like an earthquake or something.
Right, like a sudden earthquake that you just have to hastily price into the models and move on. But if you look at this through a game theoretic lens, this is classic geopolitical escalation as game theory bargaining leverage.
Oh, that's an interesting way to frame it.
Yeah, because the violence is a very loud, very dangerous form of negotiation. I say that because even amidst these missile exchanges, White House Press Secretary Caroline Leavitt confirmed that the U.S. and Iran are still actively talking.
They haven't stopped.
Exactly. They are actively trying to secure a diplomatic deal, despite the missiles literally being in the air.
That is a fascinating tension to point out, Daniel. The market is being forced to weigh the immediate physical reality of missiles flying and ships halting against the political reality of diplomats still talking behind closed doors.
Yeah.
And, while that intense geopolitical drama was unfolding in the Middle East, we also had a major macroeconomic shift happen in Asia overnight.
Oh, right, the rate hike.
Yeah. At roughly 8:50 p.m. Eastern on Wednesday, the Bank of Korea's Monetary Policy Board voted unanimously to hike its base rate to 2.75%. 5%.
And on the surface, to a U.S. equity trader, a quarter-point hike in Seoul might just sound like regional noise.
Sure.
But it matters immensely because of why they hiked. Bank of Korea Governor Shin explicitly cited massive economic growth fueled by chip industry spillover effects.
Right, because South Korea is a central node in the global semiconductor supply chain.
Exactly. The AI boom is bringing so much capital, so much intense activity into their economy that it's acting as a massive, uncontrollable stimulus. It's driving demand-side inflation across all their domestic sectors: housing, wages, construction.
It perfectly illustrates the physical economy constraints beneath digital valuations. I mean, we treat AI like it exists entirely in the cloud.
Yeah, floating up there somewhere.
Right, but the cloud is actually millions of physical servers sitting in giant warehouses, drinking up massive amounts of electricity, water, and copper. South Korea's inflation data today is just the market waking up to the fact that you simply cannot build the digital future without burning up real-world resources.
And speaking of burning up resources to build the future, that brings us right to the tech earnings that dropped early this morning, right before the U.S. bell.
Oh, the TSMC numbers.
Yeah, at roughly 1:32 in the morning Eastern Time on Thursday, Taiwan Semiconductor, TSMC, released their second quarter earnings. The historical numbers themselves were incredibly robust. But the forward-looking projections, right, their massive capital expenditure guidance, that immediately sparked serious anxieties about capital intensity across the entire global tech sector.
Because investors are finally looking at the actual receipt for the AI revolution, and it is staggering. I mean, it's not just paying software engineers to write code.
Right.
It's buying advanced ASML lithography machines that cost hundreds of millions of dollars each.
Yeah.
It's pouring millions of tons of concrete for new fabrication plants.
Yeah.
So when TSMC says they need to spend massively just to keep pace with baseline demand, investors suddenly start doing the math and asking, wait, how many years is it going to take before we actually see a return on all this capital?
So to wrap up session one, as you were logging on to your brokerage accounts for the U.S. morning, the market had already swallowed a very heavy meal. You had a higher global interest rate signaled by Korea, immediate supply chain choke points shutting down in the Strait of Hormuz, and the looming shadow of massive tech infrastructure spending required by TSMC.
It's a lot to digest.
It really is. So we are going to take a quick breather to let you digest all that, but don't go anywhere, because on the other side of this short break, we are diving into exactly how U.S. traders reacted when the opening bell finally rang.
And that reaction was violent. Which brings us to session two. What moved markets during U.S. trading hours?
Because it definitely didn't calm down.
Not at all. The inflationary heat from Asia overnight didn't just stay in Asia. By the time the U.S. opening bell rang, it collided head-on with domestic economic data that showed our own economy is running incredibly hot.
Yeah.
Combined with Federal Reserve commentary that completely erased any lingering hopes for imminent rate cuts.
So the data drop at 8:30 a.m. Eastern was the initial spark. U.S. retail sales rose 0.2% month over month, which shows the American consumer is still somehow out there swiping their credit cards.
Still spending, yeah.
And initial jobless claims remained extremely low at 208,000, meaning the labor market is holding firm. But the real absolute shocker was the Philadelphia Fed Business Index. It surged to 41.4. Wow.
Yeah, to put that in perspective for you, the consensus forecast was just 12.5.
That is a colossal beat. I mean, an index jump of that magnitude in manufacturing indicates an economy that is running at a blistering pace.
It's like looking at the U.S. economy and realizing it's a sealed pressure cooker right now.
Right.
The consumer and manufacturing sectors are running incredibly hot, and they're doing this despite Freddie Mac reporting today that the 30-year fixed-rate mortgage average just hit 6.5%.
Which is the highest we've seen since August of 2025.
Exactly. But this is exactly what we mean when we talk about lagged macro data masking real-time supply shocks. We are seeing backward-looking strength in manufacturing and retail from last month, but the market today is simultaneously trying to price in the real-time, forward-looking pain of the Strait of Hormuz closing overnight.
And that impossible balancing act is exactly what the Federal Reserve is grappling with right now. Which brings us to the central bank commentary that dropped right in the middle of the trading day.
Just past 1:15 p.m. Eastern, we heard from Dallas Fed President Lorie Logan, and she gave a very nuanced but ultimately highly hawkish speech.
Yeah, she didn't mince words.
No, she stated that while she remains very optimistic about the long-term productivity gains we might get from AI, the current massive investment demand to physically build out that AI infrastructure is highly inflationary right now.
Because it's competing for materials.
Exactly, competing for materials, for skilled labor, and especially for energy on the grid. Because of that, she bluntly advocated for modestly higher interest rates to balance the outlook.
And she wasn't alone either. Barely 10 minutes later, at 1:25 p.m. Eastern, Kansas City Fed President Schmid stepped up to a different mic and basically doubled down.
Oh, yeah, he did.
He declared that inflation is simply too hot. And what really stood out to me is that he explicitly rejected the long-held assumption that these kinds of supply-side price shocks are just transitory.
Which is a huge shift.
Right. He essentially told the market, no, we cannot look through this. It is persistent. He's looking at the same commodity boards we are, seeing oil and freight costs spike, and signaling that central bank rhetoric is acting as a substitute for policy action.
And that 1-2 punch from Logan and Schmid was absolutely devastating for risk assets. I mean, let's break down the severity of the market's response. By the closing bell, the S&P 500 had dropped to 7,533.77.
Yeah.
And the Nasdaq 100 futures plummeted over 700 points, breaking all the way down to the 29,175.25 level.
And the mechanism driving that massive sell-off is what we often refer to as discount rates as gravity. It's like interest rates are acting as a literal gravitational pull on asset valuations.
Exactly.
When Logan and Schmid push the rhetoric higher and the 10-year Treasury yield actually ticks up past 4.5%, 4.569% to be exact, that gravity gets much heavier.
It really does.
It immediately drags down the valuations of high-growth tech stocks because their massive future cash flows suddenly look a lot less attractive when discounted back into today's dollars. The higher the risk-free rate goes, the more gravity compresses those lofty valuation multiples.
Precisely. You essentially have real yields acting as the opportunity cost for holding non-yielding duration-sensitive assets. So wrapping up session 2, the combination of shockingly hot domestic data and explicitly hawkish Fed speak confirmed that we are stuck in a highly restrictive monetary environment for the foreseeable future.
Yep.
And that realization is what sent the major indices off a cliff this afternoon.
We'll take one more quick pause here. When we come back, we are going to zoom in on the specific corporate fallout from today's chaos and tell you exactly what catalysts you need to watch for tomorrow.
Let's get right into it. Session 3, corporate events recap and what to watch next.
Because we have to look at the individual names now.
Right, we've talked about the big macro pressures, the geopolitical tension in the Middle East, the hawkish Fed, the red-hot economic data. Let's look at how the massive capital requirements of the AI build-out and nationalist trade policies actually manifested in specific corporate events today.
The biggest story here is the aggressive semiconductor pullback. Following TSMC's massive Capex projections that we discussed from the overnight session, the Technology Select Sector SPDR ETF, ticker XLK, closed down over 2.24%.
Which perfectly encapsulates the core tension in the market right now.
Yeah. On one hand, investors broadly acknowledge AI Capex as existential for these companies. If you don't spend the billions on infrastructure, you just lose the arms race entirely.
Right, you're out of the game.
Exactly. But on the other hand, investors are suddenly balking at the sheer size of the check they have to write. They are looking at the bill for the plumbing, and they are heavily questioning the timeline for actual software monetization.
It is the brutal difference between buying the hype of a new technology and actually financing the physical build-out. And, adding fuel to that fire, we also had some major trade and geopolitics news hitting the tech sector late Wednesday evening.
Oh, the Trump administration news?
Yeah. Just before 11:26 p.m. Eastern Time, they announced they had secured an additional $100 billion in domestic chip manufacturing commitments. But in the exact same breath, they slapped retaliatory tariffs on Brazil due to ongoing trade disputes.
That combination is deeply illustrative of the fractured operating environment for multinationals today. I mean, securing domestic chip manufacturing is obviously great for U.S. supply chain resilience in a vacuum.
Sure.
But aggressive tariff usage reminds investors that we are in a highly nationalist global trade environment. It introduces severe cost uncertainties for any company trying to build complex hardware or source materials across borders.
And speaking of complex hardware across borders, NVIDIA made a massive physical AI push in Japan, which was announced on Wednesday.
That was huge.
Yeah. They secured huge strategic alliances with Toyota and Omron, focusing on factory robotics and industrial manufacturing. On top of that, the Japanese government officially agreed to buy 27,500 advanced NVIDIA Rubin chips for a national infrastructure project.
Wow.
Now, I want to clarify something for you all. These are massive structural wins for NVIDIA. It proves their pivot into physical, real-world AI is actually working on the ground. But today, the macro fears completely overwhelmed the micro fundamentals.
Totally ignored it.
Yeah, NVIDIA's stock got dragged down with the broader tech sell-off, with the market completely ignoring this huge fundamental victory.
It just shows that when the macro gravity gets heavy enough, individual company success stories simply cannot escape the pull. You know, with the Nasdaq 100 dropping 700 points and gold crashing below $4,000 today, you might be tempted to just pull all your cash out and hide it under your mattress.
Honestly, yeah.
But according to Dallas Fed President Logan, the energy demands of AI data centers will probably find a way to inflate the cost of your mattress too.
Oh, that's great.
I mean, we were promised AI would solve all our problems. But today, its main achievement was triggering a hawkish Fed warning. Hey, look on the bright side. At least your credit spreads remain stable.
It is small comfort, but true. High yield and investment-grade credit barely budged today, which tells us this was a duration and valuation shock, not a credit panic.
Right.
Now, looking ahead, here is what you need to watch over the next 24 hours. First, tonight at 7 p.m. Eastern, Fed Vice Chair Philip Jefferson is speaking. This is crucial for policy rate guidance to see if he echoes the hawkishness of Logan and Schmid.
Definitely. And second, you've got to keep a very close eye overnight on any White House or Pentagon updates regarding Iran and the Strait of Hormuz. That remains the paramount risk for oil and global supply chains.
And Friday morning is going to be incredibly busy. At 8:30 a.m. Eastern, we get June housing starts, building permits, and import prices. Then at 9:15 a.m. Eastern, June industrial production and capacity utilization drop.
And then the big one.
Right, finally, at 10 a.m. Eastern, we get the preliminary July University of Michigan consumer sentiment and inflation expectations. That last one will be highly scrutinized given the inflation persistence fears that drove the market today.
All right, that covers the day's action. Now